So the big question is, there's a downturn, without a doubt. You look at the markets, whether it's equities or debt or whatever, downturn. Is it affecting venture capital? And if so, how?
Well, the big macro issues that we're facing in the public markets, like inflation, supply chain challenges, and also things like the recent Supreme Court ruling that would affect EPA regulations, all of those factors come into play for the public markets. They also have implications in the private markets. However, the private markets are very, very different. So the private markets, when you think of venture, investors are looking at the medium-term time frame, not like short day-to-day trading and immediate effects, but more over a course of 7 years for a Series A level financing. And so it's a medium-term kind of investor mentality that's happening. I think it's important to know that there is so much money that's been put out into venture capital over the last few years. In 2021, we had a record amount. It was 97% over the previous year. So you think about it, we have this huge amount of capital that's already been deployed into early stage companies. We also have about 330 billion of dry powder that's already been raised and ready to deploy. So what does that mean? That really means that these venture firms, early stage companies, have a lot of fuel in the tank to keep going, to weather this current market situation.
Does that large amount of money, even huge amount of money, make your job more difficult? You're looking presumably for really great opportunities.
Yes.
If there are a lot of people in there, maybe not as disciplined as Plum Alley is, what does that mean to valuations? Are people overbidding? Do you have a tough time finding proper prices for what you want to invest in?
Yes. So at Plum Alley, we're very, very focused on the fundamentals. And I come from Wall Street. I spent 20 years on Wall Street at Goldman and other places, as do my team members. So we come at looking at venture from a kind of fundamental point of view, which means, do the companies have revenue? Do they have real customers? Do they have a real product that we need in the world? If the answer to that is yes, then you drill down and look at the numbers. And in our case, the companies that we funded have revenues, but we only look at 6 to 7 times current revenues for a SaaS company. And in the market, that number's been about 12 times revenues. So we have seen this situation where valuations have been way overpriced. And I think that's a reflection of the fact there is so much capital coming into the market. When there's a lot of capital in the market, it pumps up valuations.
But that's also presumably part of why there's a lot of dry powder, because if you're only willing to go to 7 times and people are spending 12 times, you don't spend the money. You have to sit on your money until you find the proper valuation. Where are the opportunities that you find right now that make sense?
Well, we've invested now $65 million in 27 companies. So we've been at this for 5 years. So we have had the opportunity to see the market change over time. But we have stuck to our knitting. We have stuck to the fundamentals, which is, what are the revenues? What is the company actually doing? Is the company essential for our future survival and for more productivity in industry? Does it really matter versus companies that are sort of optional, like dog walking apps?
If you're looking for transformation, because it sounds like that's what you're looking for, fundamental transformation, basic changes in our society, in our economy, where are you looking? Is that energy transition? A lot of people are doing that. Is that biotech? What sectors do you look at?
So 3/4 of our portfolio is in frontier technologies. So think of robotics, think about AI, think about sensors that are monitoring climate. And then 30% is in healthcare. So CRISPR, gene editing, therapeutics that have never been introduced in the market before. So we like that combination because we think there needs to be innovation is happening in every sector. It's not limited to healthcare. It's not limited to industry. It's not limited to human beings.
Deborah, it sounds like you're sort of swinging for the fences, as it were. I mean, you're looking for the big home run. And that means you will have more strikes, almost necessarily. There's a risk involved in that huge reward at the same time. How do you balance that ability to really get a home run against what you just said? A lot of companies in. How is there a moat around these companies?
Yes, there is, in the companies, and I can speak to the companies we've invested in, there is a proprietary technology. They own IP. It's one of the things that we look for. And these are hard technologies. It's like We've invested in a company, OnRide, that is autonomous and electric freight vehicles. They are bordering on 100 million of ARR. Maersk is one of their big clients, Oatly, GE, appliances, et cetera. So these are companies that have the fundamentals to show growth. We were very smart to do those fundamentals when we invested at a Series A level. And many of our companies are, very much are unicorns at this point, and there's still more time to go. So it's never over until the money's in the bank.
I want to come back to the downturn, if I can call it that way. Certainly we're seeing in the markets right now. You mentioned IPOs before, the possibility of IPO.
Yes.
IPOs don't look as certain today as they did 2, 3, 4 years ago, when it was almost you couldn't get out of the way of the money, essentially. Is that dampening at all your ardor for some of these companies because the IPO exit may not be there when you get there?
I think, if you look at the time horizon of being 7 years for Series A level early stage companies, there is still some time left on the companies we've invested in. We've invested in the last 3 to 4 years. So we know there's still some time to go before they're positioned for IPO. Some of our companies have accelerated and, that time frame has shortened. But, will the market be there? In my opinion, look at history. When really strong companies are ready to come to market, they will have the opportunity. It may not be every company, and it may be maybe 6 months or a year later. But where is the world going? I mean, the world is going to these technologies, to adopting these technologies, because they bring value. They bring value, they bring efficiency, they bring more productivity, they deal with the workforce, they deal with fixing our climate issues. So why is so much capital poured into this sector? Because people see the future is technology, and they want to have a piece of that. Is it risky? Of course it's risky, but don't tell me the public markets aren't risky at this point. So it's risky, but it's risk versus return. And what do you do to mitigate some of the risk? You wait till the companies are a little bit further along. You do your diligence. You kick the tires. You understand if they have a competitive moat. You understand if they own IP. And you understand, do they have to be in the world? If you have a company that does not need to be in the world, that is a risky company. Our companies need to be in the world, and we have deep conviction on that. So, matter of time, we'll see. But I'd love to come back and share with you when we have those returns and exits.
Please do, and I don't doubt the conviction. I can feel the conviction, believe me.